Greetings, members one and all of the Salivation Nation. Goldman Sachs is pretty bullish on gold. Hey, it's in their name. Makes sense. You know, a lot of them people think that Goldman Sachs Group is one of the big banking corporations that's keeping the price down for gold and silver. But let's see what this says. I'm going to find out what metal is even hotter than gold right now. Goldman Sachs Group upgraded its gold forecast for the first time this year, upping its 3-month and 6-month projections to $1,575 in 3 months and $1,600 an ounce in light of escalating trade war tensions. Gold prices were solidly above $1,500 an ounce on Monday, a level that was hit last week for the first time since 2013. After rising nearly 4% last week, gold's rally is far from over, according to analysts at Goldman, who see more upside in the metal. Now, keep in mind that, with the trade tensions going on with China right now, most of us believe that we're not going to see any deal before Election Day. I think China's going to try to hold us out, and there'll be some bickering back and forth, but this could be a new normal, and it become sort of saturated in the marketplace, which means that, people it becomes old news, and it is what it is, and who knows, potentially we could see the prices of gold and silver kind of subside a bit to that. That's my own view, but we'll see how this plays out. And then this whole notion of being baked in with the, what the Federal Reserve does. It's been speculated that, the Federal Reserve is going to lower interest rates, and now there's talk of it that it's going to happen again. And so it's sort of in the markets. And then when it happens, it's not a huge surprise. And of course, that depends on what the chairman says in the news conference. But nonetheless, gold prices have increased further as a weaker CNY sparked substantial U.S. and global growth fears. With growth worries likely to persist, gold could rise further, driven by an increased ETF allocation from portfolio managers who continue to under-own gold. We raised our 3, 6, and 12-month gold price forecast from $1,450 to $1,475, and $1,475 troy ounce to $1,575, $1,600, and $1,600 a troy ounce respectively, Goldman analysts said in a note. The U.S.-China trade war has entered the stage 2 this summer, as U.S. President Donald Trump announced a 10% tariff on the remaining $300 billion worth of Chinese imports starting on September the 1st, the note said. With the U.S. and China taking a harder line on trade, our economists no longer expect a trade deal before the 2020 presidential election, a fundamental change in view, the analyst included Sabine Shells wrote on Wednesday. A currency war with depreciating CNY plays a key role in trade war tensions and Goldman's outlook for the precious metals. Previously, China opted for stability and defended its currency in order to facilitate the ongoing trade negotiations in the background. Now, FX appears to be playing an increasingly central role in the trade tensions, the analyst said. We estimate that 10% of depreciation of CNY versus U.S. dollar would spell as much as a 13% downside to the S&P GSCI Industrial Metal Sub-Index. Weaker CNY in this case means higher gold prices due to increased global growth fears. The depreciation of the CNY led to an increase in fear, lower long-term U.S. rates, and thus a higher gold price. Thus, a substantial depreciation of the CNY could lead to more fear regarding U.S. and global growth akin to early 2016. It should be bullish gold, the analyst said. So, yeah, I think it's kind of one of those things where it looks like that everybody, and also an insider who posts on my comment section, Angel Music, also agrees that we're going to see bullish gold. Gold's ETF demand is also in strong uptrend, with Goldman upping its 2019 forecast from 300 tons to 600 tons. And now, how will this translate to the physical? Well, we've seen a little less demand for gold over the past year, as I noted in a prior article, and also the increase in silver demand, physical silver. So we'll see how this plays out. Now with the DMI, CI respectively low and trade war escalating, global equities selling off and volatility spiking, it looks like our risk scenario is playing out. Indeed, gold ETFs have recently built momentum almost as strong as in 2016, and we believe that can be maintained for the short term. And that's the thing, the short term. What about the long term? What about playing in the next year? We shall see. Like I said, I think that I'm bullish on the metals as well too, but I'm cautiously optimistic in terms of the price, and that we could definitely see this become the new normal, at least for the up until the election, and what will happen afterwards, and what will happen with Brexit. We shall see. A lot of that can come into play. If we continue to see strong economic numbers amid these tensions and geopolitical factors, well, we could see the metals fall as well. We can see the prices right now at the top here. Gold is up $15.20. Silver's up 4 cents, or up 12 cents to 1704. Solidly in the $1,500 and $17 range now for both gold and silver. But there's another metal that's even hotter than silver, than gold right now, and that is nickel. It's hotter as demand grows for batteries and electric vehicles. So this comes to us from Forbes magazine. Gold is hot, but there's another metal which is hotter, nickel. Up 30% over the past 2 months, nickel has delivered more than double the performance of gold, which is up 13% over the same time. And the gap could get a lot wider as the supply of nickel stagnates and the demand accelerates. So for those of you Canadians who have those old nickels that are 100% nickel, you might want to hold on to those for a while, or you might want to sell them. The driving force behind the current awakening of gold is well understood. It can be summed up as a flight to safety, as the China versus U.S. trade war slows global growth and values the conventional or fiat currency are debased by governments resorting to quantitative easing and other forms of creating money. Here we can see the nickel briquette. All right, very good. Bags filled with nickel briquette, nickel powder. They sit in the warehouse of the BHP Group, Kawana Nickel Refinery in Kawana, Western Australia. Look at that. The world's biggest miners include BHP Group and Glencore PLC, and are finally firm believers in the electric vehicle battery revolution. What they don't agree on is that which metals will deliver the best long-term exposure for developing global market. I wonder if silver will come into play there. Nickel's drivers are different and far easier to understand and boil down to simple ease of supply exceeding demand, which, in the past nickel booms, was essentially a case of mines failing to keep up with requirements of steel mills making stainless steel, a material which has traditionally consumed close to 80% of the world's nickel. So there's demand growing for nickel and batteries. Stainless steel remains the primary market for nickel, but there's faster growing market which, until a few years ago, was insignificant: lithium-ion batteries. Standard source of power in small appliances such as cell phones and their nickel-cadmium NICD batteries, or nickel metal hydride rechargeable batteries. The big game today is the battery packs which power electric cars such as the Tesla, Prius, and Nissan Leaf. From being a metal easily described as a one-trick pony thanks to its dominant end use in stainless steel, nickel has suddenly become a two-trick pony. And if electric cars take off as are predicted, and shortage in future years is possible. What caused nickel to run from around $5.40 a pound 2 months ago to $7.09 a pound at the end of last week was a combination of strong demand from Chinese stainless steel mills, a speculation that a major source of the metal could be cut off sooner than expected. The source under threat is unprocessed nickel ore from Indonesia, which is shipped to Canada or to China for use in steel mills as a material called nickel pig iron. Indonesia and other countries which produce NPI dislike the material because it does not require any value adding to the home market. Previous bans on NPI have crimped the industry only for it to return, but the next ban is expected to permanent, and while Indonesia has said it will not be applied until the year 2022, it could happen sooner, just as battery makers seek supplies of nickel to meet electric car demand. Look at that. That's a crystallizer used in the process of manufacturing nickel sulfate hexahydrate. Hexahydrate stands for the BHP group. There, look at that. Fascinating. I wonder if there's any of this made out of nickel, any of that apparatus there. Probably not. ANZ, an Australian bank, warned 2 weeks ago that falling stockpiles of nickel metal were a warning of a squeeze developing. Stockpiles and warehouse managed by the London Metal Exchange have been falling for the past 4 years, with an accelerating decline over the past 2, a time when reserve inventories dropped by 43% from around 250,000 tons to 142,000 tons. Nickel inventories have declined steadily since early 2018 as a persistent market deficit takes a toll, ANZ said. Some analysts suggest stockpiling by electric vehicle manufacturing is behind the depletion. Whether this is the case or not, we see the tight market, meaning further inventory drawdowns are likely. So there's a talk of panic buying. So maybe we should stack some nickel. We could buy, in fact, look around Provident Metals, APMEX, other places. You might be able to find some of the exotic metals. And I've actually got a little bit of nickel, some nickel rounds laying around. Current LME stockpiles would meet less than 2 months' supply, so panic buying is a likely outcome. It is highly unusual for a bank like ANZ to use an expression as emotive as panic buying, but it was largely because of a concern that speculators have become active in the nickel market ahead of Indonesia's reintroduction of a ban on MPI. Pure play Australian nickel mining companies are enjoying sharp share prices rises as nickel prices move up, whereas Areas has risen by 25%. Western Areas has over the past month, and Mincor, which has just re-signed supply agreement with BHP, a major producer of the nickel sulfate, which makers prefer, is up 28%. If there is a squeeze developing on nickel supplies as a major new market develops for the metal, the price could go much higher than its current $7.09 per pound. Back in 2011, when a supply shortage developed, the nickel price hit $22 a pound before falling rapidly as steel mills found substitutes for nickel in their stainless steel, including manganese. No one is talking about a nickel boom as powerful as that in 2011, but nickel has a strong track record of extreme moves up and down. So it's a volatile metal. It's a speculative metal. So for those of you who are interested in such a thing, if you can find bars and nickel out there and a market to resell it if you need to when it goes up, it may not be a bad play. Like I said, I've got a little bit of just a couple of rounds, but it'd be kind of neat to have a nickel bar. Who knows? I might look into getting a nickel bar. I'll probably be paying a heck of a lot. I'll probably be paying, I'm more than likely about $10, $15 for a kilo of it, or what have you. No, not a kilo, probably for $10, $15 for a 5-ounce bar or something like that, or 10-ounce bar. What are your thoughts? It's kind of interesting with all the gold going on. Some of these base metals are making some movements too, and nickel being one of them. It's kind of a fascinating area for those in the trading world. Something to kind of take a look at and see what you think. Fascinating indeed. Post your thoughts below. Would like to extend a multitude of gratitude to you all for watching, and encourage you to please rate, share, comment, and subscribe.